A reverse market crash, actually a much worse economic outcome for many people. Now, a reverse market crash sounds weird, right? Like, what does that mean? And why is it the worst possible outcome? You see, markets can actually crash in two different ways. Most people think about a deflationary crash, but there's also an inflationary crash. Now, one of these resets the markets, making it easier for people to jump back in, and the other just leaves the majority much further behind. But don't worry, I got you. In this video, we're gonna look at what a crash actually is. We're gonna look at the two types of crashes and why everyone is looking at, fearing for the wrong one. We're gonna take a historical look at the two types of crashes, what this means to you, and the game plan for not just surviving the reverse market crash, but actually using it to your advantage. So let's go. All right, welcome to the channel. If you're new, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong, and seems like all the doom and gloomers on YouTube and social media have been wrong as well. And we're gonna correct that today. Now, imagine a world where your savings are worth less than yesterday, where your job is no longer secure, and you can no longer afford your standard of living. Now, this isn't a dystopian future. It's a reality that could be triggered by a reverse market crash. It is being triggered by that. Today, we're gonna dive into the two faces of these economic nightmares, deflationary and inflationary. We're gonna uncover which one might reset the economy and which one could leave you much further behind if you don't do anything. All right, so let's just talk real quick. Let's jump right into it. Two types of market crashes. Now, most people are afraid of, all the people on social media and YouTube are talking about a market crash, a recession, a deflationary crash. Deflationary. Now, deflationary is a period of deflation when things slow down, when asset prices and prices drop in general. Now, this typically means then we have economic activity slowing down. Businesses then struggle because they have, less consumer spending money there, lower profits. And then this potentially leads to layoffs and higher unemployment rates. Now, the important point that we're going to talk about on both of these is what is a market crash, or what is a crash? So a crash, in this example, a deflationary crash means that your income went down, potentially. You lost your job, you got another low-paying job. Your business doesn't make as much money as it did before, right? So your income goes down, and so you can no longer afford your same standard of living. This is the key piece here, all right? So a crash that everyone's afraid of in a recession or whatever, my standard of living goes down. Potentially I have to move to a smaller house, I can't go out to dinner as much, I can't take vacations, I have to wear the same clothes, whatever that is, my standard of living went down. Okay, and so that's what everyone's afraid of in a deflationary crash, all right? But there's also the reverse market crash. The reverse market crash is an inflationary market crash. Now, this is the opposite. Now, instead of prices going down, we see a rapid increase in prices. These rapid increases in prices are caused by many things: supply chain disruptions, a rising production cost, rapid expansion of the monetary supply, and this also erodes your purchasing power. Now, does it sound familiar? That's what we've seen for the last 3 years, right? We've seen prices go up so fast that you can no longer afford the bigger house. You can no longer afford to take that vacation. You can no longer afford to eat steak and milk. Now you're eating, hamburger meat or whatever it is. And so the market crash caused your standard of living to go down, but instead of asset prices going down, deflationary, it's because they've gone up. It's the same thing. Now, this is what we've been seeing, like I said, for the last couple of years. Now, for the last year, over a year now, you've seen people, Michael Burry, for example, famous for The Big Short, tweeting last November, sell, and then deleting his Twitter account. January, sell everything. The Big Short, he's placing massive shorts against the market, and he continues to lose money. All the doom and gloomers, you got the Harry Dent Jr.'s, the market's gonna crash 80%, the real estate market's gonna crash last year, 2022 it's gonna crash, 2023 it's gonna crash. Here we are at the end of the year, it hasn't done it. As a matter of fact, the S&P 500 is up 20% year to date. Bitcoin is up 166% to date. Now, I don't want to toot my own horn, but let's look at a couple of the videos. Since last October, I've been saying, we're gonna see an inflationary crash. The markets are not gonna go down. In January, I said, it's time to start buying assets again. Even just in August, I put out a video saying why this bear market was canceled, and since then, Bitcoin's up another 50, 60%. So what comes next? How can you prepare for this? And so anyway, I'm gonna cover this in this video, but I'm gonna go deep. Next week, I'm gonna do a live presentation if you wanna come join me. I'm gonna have about probably 30, 40 slides, really breaking this down so you can understand factually from data what's gonna happen. And then most importantly, we're gonna look at what assets we should be buying. Where should we be putting our money so we can take advantage of this? While everyone's out there scared, sitting on the sidelines, there's a lot of money to be made. If you wanna come, it's free. There's a link down below. Come hang out with me and I'm gonna answer all your questions live. It's time to get access to me for free, so I hope to see you there. There's a link down below. Now let's run through some historical examples of both inflationary and deflationary market crashes so that you can understand them a little better. So first, let's look at the inflationary ones. So Weimar Republic of Germany is probably the most famous example. In the 1920s, after World War I, Germany saw massive hyperinflation because of the currency devaluation that was there. Now, why? We want to understand this, okay? So because of the war, Germany was faced with massive war reparations. They had to basically pay to fix everything, right? And this was stipulated by the Treaty of Versailles. Now, they didn't have the money to do this. They didn't have the money to rebuild the infrastructure, and so they had to expand the monetary supply. Sort of like the Biden administration's Build Back Better, or the Inflation Reduction Act, where they want to spend $1.7 trillion to rebuild the infrastructure, but we don't have the money, and so we're expanding the monetary supply to pay for that. You see, you have to understand history. Now, because of this, combined with the lack of economic production, sound familiar? Because of political instability that was there, sound familiar? This is what threw Germany into this inflationary bust. Now, under this Treaty of Versailles, they imposed the reparations on Germany. Now, the amount of money that Germany had to come up with was about 132 billion gold marks. It was equivalent to about 33 billion at the time. Today, it's about 553 billion. Now, I know today in the United States, we throw around a trillion. We lose reference to what these numbers are, but it was 553 billion. A massive number. Compare this to today. The largest debtor nation to the IMF is Argentina with only 31 billion. So the largest debtor is 31. They owed 553 billion. Now, let's look at a couple other things. So before the hyperinflation, back then paper money still equaled gold. The German mark still equaled gold. So in 1914, the exchange rate was about 4.2 marks to $1 US. That was about the exchange rate. And the gold standard was approximately 2,790 marks per ounce of gold. Now that was before hyperinflation. After hyperinflation, from 1914 to 1923, the exchange rate was 4.2 trillion marks to $1 US. From 4.2 marks to 4.2 trillion marks. Now let's look at another one that you don't hear as much, but it's actually much worse, much more dramatic, and this is Zimbabwe. They have tried to have their own currency multiple times. The first Zimbabwe dollar in 1983 was 1-to-1 with the US dollar. One Zimbabwe dollar equaled $1 US. 1983. By 1997, about 15 years later, it was now 10-to-1. 3 years later, 2000, it was now 100-to-1. 6 years later, it was 500,000 to 1. Now, that doesn't work anymore. Let's tear that up. Let's throw that away. Let's start over. So let's start with a new Zimbabwe dollar. August of 2006, it was 650 to 1. By the end of that year, from August to December, it went to 3,000 to 1. By December of the following year, it went to 4 million to 1. And then it didn't even get through another year. Halfway through the next year, July of 2008, it was 758 billion to 1. So in less than 2 years, it went from 650 to 1 to 758 billion to 1. So let's tear that up. Let's try it again. August 2008, a new one came out, 1,780 to 1. And by November of that year, just a few months later, it was 13 quadrillion to 1, whatever that number even is. Okay. Argentina, another good example. We're witnessing this going on right now. They've had triple digit, 100% plus inflation for the last couple of years in a row. Massive instability there. Of course, now the political system is being upended. A new president there, I did a video on that. We'll link to it up here. President Javier Milei, which I'm hopeful that could turn that country around. Now let's look at a couple historical examples of deflationary market crashes. All right, so the famous one is the Great Depression, 1929. And basically, we saw asset prices go down. Stock market crashed. Banks went under, and we went into sort of this deflationary spiral. The stock markets crashed over 80%. We saw 9,000 banks fail. Took about $7 billion in customers' deposits with it. And about 25% of the nation's total workforce, they were unemployed. Massive, massive unemployment. So of course, during that time, people were broke and they couldn't afford to live. Another good example was Japan's lost decade in the 1990s. From 1991 to 2003, the Japanese economy, as measured by GDP, basically didn't grow. It's kind of stagflation. It grew at about 1% annually. That was way below all the other industrialized nations at that time. Of course, at that time, stocks and real estate crashed, so we saw this deflationary crash. And then probably the most famous one for each one of you listening is the 2008 Great Financial Crash, which was really a housing market collapse. Between 2007 and 2010, there was approximately 8.1 million homes foreclosed on. Lehman Brothers filed for bankruptcy in September 2008. Bear Stearns, AIG had to get government bailouts. The U.S. stock market, the S&P 500, fell by approximately 56%. So that is the last one that's sort of in everybody's mind. This is a case of the generals always fighting the last war. Because 2008 was a deflationary crash, because it was a housing market collapse, everyone thinks we're having another housing market collapse. Everybody's expecting a deflationary crash. Everybody's expecting, just like in 2008, stocks to drop by 50, 60%, home prices to drop by 30, 40%. Your retirement accounts don't have enough money. And if you're retired, you probably have to go back to work. Why? Because you can no longer afford your standard of living. I know in 2008, my standard of living got cut big time. All of my friends' standard of living got cut big time. But what we're seeing now is something different. And I've been talking about this for over a year. I'll link to all the videos down in the description down below so you can dig in deep and understand why this is happening. I've made 8-10 videos on this. All right. It's an inflationary bust that we're facing. We've already been seeing it. Remember, like I said in the intro, steak is up, milk is up, gold is up. Real estate is up. You can't afford the same standard of house that you could have a couple of years ago. But here's the thing. Inflation is a double-edged sword. Now, inflation is sort of a crash. It does take away our purchasing power, but it can also make us a lot of money if we know how to capitalize on inflation. You know the saying, the rich get richer and the poor get poorer. Why is that? Why do the rich get richer? Well, they use inflation. The rich get richer because of two reasons. One, they own assets. Inflation pushes asset prices up. Inflation pushed home prices up. Inflation pushed gold, Bitcoin, uranium up, right? And so if you own those assets and inflation pushes the prices up, you're like the rich, you get richer. They own assets. The other thing is that the rich own income. So they own businesses that make more money from inflation as well. So as the prices of those goods and services go up, their businesses make more money and they're able to offset that inflation with raising their income or raising their pay. All right. And so this is what we're facing. We're facing this and we can benefit from it just like the rich do. Now, why I said in the intro that this is sort of the worst case outcome is because in a deflationary crash, it's sort of like a reset button. I have kids and at the pace that we're going, they'll probably never be able to afford a home in this area where I live. They're just getting further and further behind. Stocks are getting further and further behind, basically in every asset. If we had a massive deflationary crash where home prices drop by 50%, stock prices drop by 50%, it would be an amazing opportunity for the millennials and younger to get into the market and ride it back up. So deflation, while very painful, is like a reset button and it gives people a chance. It sort of cleanses the system and allows us to regrow. The problem with this inflationary bust and why I think it's worse, although we can use it to our advantage to make a lot of money, it leaves the people out of the market further behind. I don't know, home prices could drop a little bit in the next 6 months, 9 months, but in 3 years, I'm pretty confident they're going to be up 50%. So when my kids are ready to buy houses, how will they be able to afford it? The problem with this inflation is that you just get further behind. And so what you need to do is you need to throw your line in the water. You don't want to get pushed further behind. So here's how we do it. Again, just like the rich, we want to buy assets. What type of assets should we be buying? I break them into three categories. We have assets that beat inflation, assets that keep up with inflation. And so the best ones that can beat inflation are scarce assets. This is fine art, collectibles, lakefront, beachfront property, Bitcoin fits into that, all right? Those assets can all outperform inflation. Then you have assets that keep up with inflation, so the S&P 500 and the median US real estate is a perfect proxy for inflation. If you own either of those assets, you're not losing money, but you're not really getting ahead either. I like energy-intensive assets. Energy-intensive assets are typically commodities. This could be any of the metals, copper, lithium, nickel, because it requires a massive amount of energy to get them out of the ground. They're not as scarce as lakefront or beachfront property, but it does require energy to get them out. Cattle could also fit into that as well. And I would typically stay away from just financialized speculative assets because those can just be inflated away. All right, so those are the types of assets that we want to own. Now, the other way that we can benefit from this would be with leverage. So imagine if you were in Argentina, or let's say Turkey, the Turkish lira has lost 95% to the US dollar in the last 5 years. So if you were in Turkey and you had a time machine, you can go back 5 years, what should you have done? Well, you would have wanted to get out of the Turkish lira and move into the dollar. That would have done really, really well for you. A better option would have been to borrow as much money in Turkish lira as you could have because it all got inflated away. Sort of like when a couple of years ago, smart people were getting millions of dollars or however much they could get in real estate loans, fixed, 30-year fixed at 2-3%. Now, you might be watching this going, Mark, how dare you say that? I missed it. It doesn't work for me. Well, right now, you can get it for about 7%, and I think that's still gonna be a pretty good deal from what we're gonna be facing in the years ahead. So, buy assets, own businesses, or be able to increase your income, and 3, use leverage if you got it. Again, I'm gonna do a whole presentation for an hour. I got about 35 slides to really break down why I think this is really gonna happen, how we're already seeing it, and more specifics as to what specific assets we can buy in those categories. And I'm gonna answer all your questions. It's all for free. There's a link down below if you want to come hang out with me. Cool, but don't get left behind. Like I said, in a deflationary crash, at least it's being reset. But in this inflationary crash, if you don't grab that line and go with the market, you could end up being left behind. Are you long enough? All right, leave me a comment. Let me know, are you long enough? Yes or no? Let me know if you like it. Give me a thumbs up if you do. Not, you can give me a thumbs down. That's okay. At least leave me a comment. Tell me why. Subscribe if you're not already subscribed. And that's what I got. To your success.